Forget the conventional wisdom of buy low and sell high. For legendary investor William O'Neill, the secret to extraordinary stock market success lies in a counterintuitive approach, buying stocks only when they are making new high prices, a strategy he calls CANSLIM. And just as important, rigidly cutting losses at a maximum of 7%. So let's unpack what he's saying here. When William O'Neill started out as a stockbroker way back in 1958, he tested all the common advice he was hearing. And what he found was that the so-called bargains, those stocks with super low prices or low PE ratios, well, they were usually cheap for a very good reason. The real data, the stuff he pulled from the market's biggest winners, told a completely different story. So that leads to a pretty big question, right? If that old mantra that we've all heard a million times is actually flawed, then what really works? What did the greatest stocks in history all have in common right before they just took off like a rocket? O'Neill was absolutely determined to let the data give him the answer. His journey didn't start with some complicated theory. It started with a really practical question. What were the best investors of his time actually doing with their money? So he decided to just ignore all the talk, ignore the commentary, and focus purely on the trades. He started analyzing the moves of the era's absolute top-performing funds. And this, right here, is the core of what he found. It flips everything on its head. See, conventional wisdom tells us to hunt for a bargain, to buy a stock when it's near its lows. But O'Neill's research showed the exact opposite was true. Buying a stock just as it broke out to a new high price wasn't being reckless. It was a powerful signal that the smart money was recognizing the company's real strength. His big eureka moment came when he was studying the Dreyfus Fund, which was just wildly successful at the time. He charted every single one of their purchases, and this undeniable pattern just jumped off the page. Like he says here, it wasn't just some of their winners, or most of them. Every single one was bought as it was hitting a new high. This wasn't the exception, it was the ironclad rule. So this one discovery became the cornerstone for a whole new way of thinking. O'Neill then spent years digging deeper, basically reverse engineering the market's greatest success stories to build a concrete 7-point model to spot the next round of big winners. He called it CANSLIM.
So what is CANSLIM? Well, it's an acronym, and each letter stands for one of 7 key traits that history's superstar stocks all shared right before their huge runs. And let me tell you, the system is incredibly selective. O'Neill figured that at any given time, fewer than 2% of all the stocks out there will actually meet these strict criteria. You're not just looking for an average company, you're hunting for the absolute elite. Let's start with C, current quarterly earnings. O'Neill found that the best stocks, right before they took off, showed a massive jump in earnings. We're talking an average of 70% in the most recent quarter compared to the same quarter last year. It's just a screaming signal of explosive, recent growth.
Next up is A for annual earnings growth. This one goes hand in hand with C. A single great quarter is fantastic, but you want to see a real track record, right? You don't want a one-hit wonder. His research showed that these top companies had an average annual growth rate of 24% over the last 5 years. That proves their success is consistent and sustainable. N stands for new, and this is such a critical catalyst. Get this, 95% of the greatest winning stocks had something new going on. A game-changing product, a revolutionary new service, maybe a new CEO shaking things up. And crucially, new also means a new high stock price. That's the ultimate confirmation from the market that something big is happening.
Okay, we're almost halfway through the formula. These next few letters are all about how you separate the true market leaders from all the other wannabes in the pack. How do you find the best of the best?
S is for supply and demand. O'Neill looked for companies with a smaller number of shares out there for the public to buy, usually under 25 million. Now, why does that matter? Well, it's basic economics. With a smaller supply, even a reasonable amount of buying from big institutions can have a huge impact on the stock's price. And that's what fuels those really powerful upward moves. L stands for leader or laggard, and you only want the leaders. O'Neill's favorite tool for this is called relative strength, or RS. It's actually a pretty simple metric. It just ranks a stock's price performance over the last year against every other stock on a scale from 1 to 99.
And just look at what his research on relative strength found. The average RS rating for the best performing stocks right before they made their big move was 87. Think about that for a second. They were already outperforming 87% of the entire market. So this led to a really simple, firm rule. Don't even consider buying a stock with an RS rating below 80. This system is all about buying proven strength, not gambling on turnaround stories.
I is for institutional sponsorship, and you can think of this as the Goldilocks rule. You want it to be just right. You want to see some ownership by professional institutions like mutual funds. That's a stamp of approval, a sign of quality. But you don't want too much. If every institution on the planet already owns a stock, it's probably too late, too obvious. There's no one left to buy it and push the price up. And finally, we have M for market direction. You can think of this as the weather report for your investing. O'Neill's research was crystal clear. 3 out of every 4 stocks, even the absolute best ones, will follow the trend of the overall market. You can pick the most perfect stock in the world, but if you're trying to fight a raging bear market, the odds are just stacked against you.
So that's the CANSLIM formula for buying, but that's only half the equation. O'Neill was totally convinced that the real secret to long-term success isn't just about how you pick your winners. It's about how you handle your losers.
Look, no system is perfect. You are going to be wrong. You will make mistakes. But O'Neill argued that you can be right only half the time and still make an absolute fortune. But, and this is a big but, only if you are completely ruthless about cutting your losses. Winning is just as much about playing great defense as it is about playing great offense. And here it is, his ironclad rule for defense. Never, ever let a loss in a stock go past 7% from what you paid for it. Not 8%. Not 10, 7. It's automatic. It's non-negotiable. There's no second guessing. This one simple act of discipline is what protects your money from a catastrophic loss and lets you stay in the game. To really drive home the psychology here, O'Neill used to tell this story about a turkey trap. A farmer has a trap with a dozen turkeys in it, but then one walks out. He thinks, I'll just wait for it to come back in. Then 2 more walk out. Now he's thinking, man, I should have just been happy with 11. He keeps waiting and hoping, and pretty soon they're all gone. The moral is simple. Don't get caught in the trap of hoping a loser will come back. Cut the loss and move on. The CANSLIM formula and that 7% sell rule are incredibly powerful tools, but they are completely worthless without the personal discipline to use them flawlessly every single time. And there's no better proof of this than the story of O'Neill's own protege, a guy named David Ryan. So this guy, David Ryan, worked with O'Neill and just completely adopted the system. He went on to win the U.S. Investing Championship 3 years in a row, posting absolutely mind-boggling triple-digit returns. And what was his secret? He didn't invent anything new. He just mastered the discipline it takes to follow O'Neill's model with total, absolute fidelity. Just look at this list of common mistakes. Does any of this sound familiar? Every single one of them is a direct violation of the system's discipline. Averaging down on a loser, you just broke the 7% rule. Holding on and hoping, you're stuck in the turkey trap. Being afraid to buy a stock at a new high, you're ignoring the very foundation of this entire strategy. The whole system is designed to save you from these exact self-destructive habits. So ultimately, the CANSLIM model is way more than just a checklist. It's a complete system. It's got a data-driven formula for finding the winners and an ironclad rule for managing your risk. But as David Ryan's story proves, having the map is only useful if you actually follow it. So the final question really isn't about whether the system works. It's whether an investor has the discipline to work the system.